Microsoft just did something that should be impossible. They beat Wall Street's expectations by $1 billion. Revenue hit $81.3 billion when analysts only expected $80.3 billion. Their earnings per share crushed forecasts, coming in at $4.14 versus the expected $3.91. Azure, their massive cloud business, grew 39% year over year. These are the kind of numbers that usually send a stock soaring. But here's what actually happened. The stock collapsed 12% in a single day. $350 billion in market value just vanished. Gone in 6.5 hours of trading. That's more money than the entire worth of Netflix, erased before lunch. So how do you win and still lose? How does a company beat every metric and get punished for it? I'm about to show you why Microsoft's earnings triumph turned into a disaster and what it reveals about the AI infrastructure game that's consuming billions of dollars right now. Because this isn't really about Microsoft. This is about how markets price future expectations versus present reality, and why the companies spending the most money today might be walking straight into the most painful correction tomorrow. Imagine you're at a high-stakes poker table. You've been betting big all night. Everyone knows you've got a strong hand because you keep raising. Finally, you flip your cards. Full house, kings over tens. That's a winning hand in almost any situation. But then something strange happens. Everyone else looks at your cards, nods, and cashes out. They leave because yes, you won tonight, but you've been betting so much money that your future hands need to be even better just to break even, and they're not convinced you can pull that off. That's exactly what happened to Microsoft on January 29th, 2026. Let me break down what the earnings report actually showed because the details matter more than you think. Microsoft reported $81.3 billion in revenue for the October through December quarter. That's up 17% from the previous year. Their intelligent cloud segment, which includes Azure, hit $32.9 billion, up 29%. Azure specifically grew 39%. On the surface, these numbers look incredible. Most companies would do anything for growth rates like that. Wall Street had predicted $80.3 billion in revenue. Microsoft beat that by a full $1 billion. That's supposed to trigger celebrations. But here's where things get interesting. Azure grew 39%, which sounds amazing until you check the previous quarter. Azure grew 42% in the quarter before this one and 31% in the quarter before that. You see the pattern forming. The growth rate is slowing down. Now, you might be thinking 39% growth is still phenomenal for a business doing tens of billions in revenue. And you'd be right. But here's what you need to understand. Markets don't care about what happened last quarter. They care about what's going to happen in the next 12 quarters. And when you're Microsoft, trading at a price-to-earnings ratio of 30, the market is pricing you for acceleration, not deceleration. There's always this moment in analyst calls where the CEO tries to manage expectations. On Microsoft's call, Satya Nadella talked about strong demand for Azure AI services. Then came the line that changed everything. He mentioned that capacity constraints would continue through at least the end of their fiscal year, which is June 2026. Let me translate what that actually means. We could sell more, but we literally can't build data centers fast enough to meet demand. That sounds like a great problem to have, right? A sold-out business with people begging to give you money, except it tells investors something uncomfortable. It means that 39% growth might be the ceiling, not the floor, for the next 6 months. And markets absolutely hate uncertainty about upside potential. Now let's talk about the number that really spooked the big investors. Capital expenditures. Microsoft spent $37.5 billion on CapEx this fiscal year. That's up 66% year over year, $37.5 billion. Let me give you context for how insane that number actually is. Back in 2010, Microsoft's total annual revenue was $62 billion. They're now spending more than half of their entire 2010 revenue just on building infrastructure for AI in a single year. Here's the thing about capital expenditures that most people don't understand. They're not like regular operational expenses that show up on your income statement and reduce your net income. CapEx gets capitalized on the balance sheet and depreciated over time. So when Microsoft spends $37 billion building data centers and buying NVIDIA chips, it doesn't immediately hurt their reported earnings. But it absolutely destroys their free cash flow. And free cash flow is what actually matters to investors who know what they're looking at. Let me show you the math that's making people nervous. Microsoft generated $28.7 billion in operating cash flow last quarter. That sounds great until you realize they spent $11.4 billion in capex in that same quarter. That's roughly 30% of their operating cash flow going straight into infrastructure before they can return anything to shareholders. Now project that forward. If capex keeps growing at 66% year over year, while revenue is only growing 17%, you've got a serious math problem. The gap between what you're earning and what you're spending is getting wider. That's the opposite of what mature, profitable tech companies are supposed to do. But wait, you might be thinking, isn't this investment in AI infrastructure supposed to generate massive returns later? Shouldn't we be celebrating that Microsoft is going all in on the future? This is where the psychology of money gets fascinating. Markets look forward, but they also calculate probabilities. When Microsoft spends $37 billion on AI infrastructure, they're making a bet. The bet is that this investment will generate returns that justify the capital deployed. But here's the truth nobody wants to say out loud. Nobody actually knows what those returns will be. Think about it this way. When Amazon built out AWS infrastructure in the early 2000s, they were creating a completely new market. There was no cloud computing market before AWS. So every dollar they spent opened up entirely new revenue streams that didn't exist before. But when Microsoft spends billions on AI infrastructure today, they're mostly fighting for market share in an existing AI services market against Google, Amazon, and a dozen well-funded startups. The total market might grow, but it's not wide open territory. It's trench warfare. And here's the part nobody wants to say out loud. The economics of AI infrastructure might be fundamentally worse than the economics of traditional cloud computing. When you sell compute hours on Azure for traditional workloads, your gross margins are in the 60 to 70% range. You're selling virtualized infrastructure that costs relatively little to replicate. But when you sell AI inference or training, you're burning through expensive NVIDIA H100 GPUs that cost $30,000 each and have a useful life measured in months, not years, because the technology is advancing so fast. Your margin profile might be 20 to 30 percentage points worse. Let me paint you a real scenario to make this concrete. Imagine you're a portfolio manager running a $400 million technology fund. You own 2 million shares of Microsoft at an average cost of $400 per share. That's an $800 million position that's oversized for your fund because Microsoft has been running so hot. Now earnings come out. Revenue beat by $1 billion. Azure growth decelerates slightly. Management guides for continued capacity constraints. Capex is up 66%. You have about 90 seconds to make a decision before the after-hours market moves without you. Here's what runs through your head in those 90 seconds. Microsoft is priced at 30 times earnings. The market is pricing in continued acceleration, but you just heard deceleration. The company is spending money faster than revenue is growing. That typically compresses multiples. If Microsoft's PE ratio drops from 30 to 27, that's a 10% haircut on your position. That's $80 million in losses on an earnings beat. Your risk management system is screaming at you to reduce the position. So you sell 500,000 shares after hours. And you're not alone. Every other institutional investor is running the exact same calculation. That's how Microsoft loses $350 billion in market cap on a day when the actual business performed well. But here's the part that should terrify anyone who owns mega-cap tech stocks. Microsoft isn't special. This exact same dynamic applies to Google, Amazon, Meta, and every other company betting billions on AI infrastructure. They're all playing the same game. Spend huge money now, hope the returns materialize later, pray the market stays patient. But patience is not the market's default setting when interest rates are sitting at 4.5% and you can get a risk-free return in treasury bills. Picture this scene. You're listening to a Microsoft analyst call. Some junior analyst who got the question pre-approved asks, "Can you talk about the return on invested capital for your AI infrastructure spending?" There's a pause. Then the CFO responds, "We're confident that our strategic investments position us well for long-term value creation." That's corporate speak for we have no idea. But we can't afford not to spend this money because if we don't, Google will eat our lunch. Here's a dirty secret about AI infrastructure spending that nobody wants to acknowledge. A huge percentage of this capex is defensive. not offensive. Microsoft isn't spending $37 billion because they've calculated an exact ROI and determined it will generate sufficient returns. They're spending it because if they don't, they risk losing cloud market share to AWS and Google Cloud. It's an arms race, and arms races have a nasty habit of destroying returns for everyone involved. You might win the war, but bankrupt yourself in the process. Let's zoom out and look at the incentive structure, because that's where you find the real truth. Satya Nadella's compensation is tied to revenue growth and stock performance. The board wants to see Microsoft maintain its position as a $2 to $3 trillion company. Institutional investors want continued growth to justify the valuation multiple. So what does Nadella do? He spends aggressively on AI infrastructure because the alternative is to look weak and defensive. He guides for strong future growth because that's what keeps the stock elevated. But here's the problem. Everyone knows this game. And when the music stops, when growth doesn't materialize at the rate required to justify the spending, the stock gets hammered. I've been running my own business for over 10 years. I've been in rooms with accountants and fiscal lawyers who explain how companies really work behind the polished earnings presentations. Here's what I learned. Companies optimize for quarterly results and stock price, not long-term economic efficiency. Microsoft spending $37 billion on CapEx isn't necessarily the optimal business decision. It might be the optimal stock price defense decision. Those are two very different things. Now, you're probably asking yourself, if Microsoft can beat earnings and still drop 12%, what does that mean for everything else in your portfolio? Here's the uncomfortable answer. We're in a market environment where expectations have outrun reality for a lot of big tech names. Microsoft was trading at a PE of 30. That's expensive for a company growing revenue at 17%. The stock had run from $344 to $555 in less than a year. That's a 60% gain. The market was pricing in perfection, and perfection is a brutally hard standard to meet, especially when you're spending money at an accelerating rate while your growth rate is decelerating. The real insight here is about the gap between operational performance and stock performance. Microsoft, the business, is doing fine, revenue is growing, Azure is growing, they're generating tens of billions in cash flow. But Microsoft, the stock, was overpriced relative to the near-term trajectory of the business. And when reality catches up to expectations, the adjustment is violent and sudden. This is the part where most finance content creators would tell you to stay calm and think long-term and don't panic sell. I'm not going to tell you that because it's lazy advice. What I'm going to tell you is to understand the incentive structure of the market you're playing in. Microsoft didn't become a bad company on January 29th, but the market's willingness to pay 30 times earnings for a company with decelerating growth and exploding CapEx evaporated. That's information you need to use. Here's what you absolutely need to take away from this. First, earnings beats don't matter if the growth trajectory disappoints. Microsoft beat revenue by $1 billion, and it meant nothing because Azure growth decelerated. Markets price the derivative, not the absolute value. They care about acceleration, not just growth. Second, capital expenditure matters more than reported earnings when you're trying to value a business. Microsoft can show strong earnings while burning cash on infrastructure spending that may or may not generate adequate returns. Free cash flow is the number that doesn't lie. Third, when mega-cap tech stocks are priced for perfection, even minor disappointments trigger massive multiple compression. Microsoft lost $350 billion in market cap because investors repriced the multiple from 30 to 27. That's a 10% correction on a stock that was already expensive. If you own Microsoft or any other mega cap tech stock betting billions on AI, here's a question you need to answer honestly. Are you owning it because the business fundamentals justify the valuation? Or are you owning it because it's been going up and you're afraid of missing out? Those are two completely different investment theses. One of them survives days like January 29th, 2026. The other one gets destroyed. Look, I have multiple hundreds of thousands of dollars invested in the market. Real skin in the game. And days like this remind me why boring diversified index funds have built more fortunes than any crypto meme. Because when you own boring diversified index funds, you don't care if Microsoft drops 12%. You own a tiny sliver of Microsoft alongside 3,000 other companies. But when you're concentrated in mega cap tech, because it's been the only thing working for 3 years, you're exposed to exactly this kind of violent repricing. The market doesn't care about your narrative or your thesis or your conviction. It cares about math. And when the math stops working, when revenue growth is 17% but CapEx is up 66% and the PE is 30, something has to give. In this case, what gave was $350 billion in market cap in a single trading session. Microsoft will probably be fine long term. Satya Nadella is a competent CEO. Azure is a real business generating real cash flow, but the stock might be dead money for a year or two while the business grows into the valuation. And that's the real lesson here. Valuation always matters eventually. Maybe not today, maybe not this quarter, but eventually price has to converge with value. And when it does, the adjustment is brutal. For anyone who bought at the top thinking it's Microsoft, it only goes up. Here's what you need to understand. You confused a good company with a good stock. And that confusion costs real money, because a great business at the wrong price is still a losing investment. The stocks that seem unstoppable are often the most vulnerable to sudden repricing. Microsoft proved that on January 29th, when winning still meant losing. The companies building the future don't always reward the investors funding that future, especially when the cost of building exceeds the speed of returns. Wall Street will tolerate aggressive spending only as long as growth keeps accelerating. The moment that acceleration slows, even slightly, even while staying strong, the calculus changes instantly. What looked like visionary investment yesterday becomes reckless spending today. The narrative flips in 90 seconds during an earnings call. One quarter of slightly slower growth, one mention of capacity constraints, one CapEx number that's too high, and billions vanish. This is what happens when stocks get priced for perfection in an imperfect world. Microsoft's engineers are still building revolutionary technology. Their cloud infrastructure still powers millions of businesses. Their AI capabilities are still advancing. None of that changed on January 29th. But the price investors were willing to pay for that future, that changed dramatically. Because at some point, the future has to become the present. The investments have to generate returns. The spending has to slow down. The growth has to justify the valuation. And if any of those things don't happen on schedule, the market doesn't wait around to give you more time. It reprices you instantly and violently. Microsoft learned that lesson with a $350 billion price tag. The question is, who's learning it next? And which stocks in your portfolio are priced for a perfection they can't possibly deliver?